Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Sergey Nazarov, co-founder of Chainlink. He's here to discuss capital markets adopting blockchain and navigating the fragmentation within the multi-chain landscape. Chainlink has securely facilitated over $9.7 trillion in transaction value and is enabling the largest financial institutions in the world to develop full future-proof blockchain applications and tokenized assets. Sergey, it's great to see you as always. Welcome back to the studio.
My pleasure. Thank you for having me.
You got it. What does blockchain technology make possible for the capital markets?
So I think there's three big trends. One of the back office trends that's not fully understood but is very valuable is collateral management and the ability for collateral to be efficiently more quickly moved between counterparties so that they don't lose the ability to earn interests on hundreds of billions of dollars in value. So even if it's 1 day of interest on $100 billion, that's a lot of money. The second one is opening up big markets, so tokenizing new things. Tokenizing real estate, tokenizing carbon credits, tokenizing private equity, tokenizing all of these assets at the edges of the financial system that aren't fungible, aren't easy to trade, aren't easy to transact in. And then I think the third one is just a big overall seismic shift in how risk is managed by both asset issuers and purchasers, because you have a way to know more about the asset when it's on chain.
So tell us about Chainlink. Where do you fit within the ecosystem? How are you enabling a unified golden record for institutions transacting with digital assets across different systems?
Sure, so unified golden record fits into the third trend of risk management, where you can have an on-chain representation of a mortgage-backed security or real estate holding or a carbon credit or a gold, piece of gold, and that representation will be updated with a lot of very relevant data that allows people to manage risk. So imagine if you knew everything about a mortgage holder before the global financial crisis, before 2008. You knew how many houses they had, you knew what their interest was on their loans, you knew what their credit score was and how that was changing. You would be able to detect very worrying patterns of a lot of bad debt, bad activity being packaged in a certain way. So the unified golden record is something that is now being adopted across the capital markets as a way to prove to the purchaser on a consistent basis. So you don't have to wait a year for an annual audit by a person. You can know second to second if the house has been resold, if the gold is there, if the carbon credit is still valid, if the tokenized private equity fund has had a distribution or not. All of this information no longer needs to reside within the systems of the issuer. It can now reside in this kind of data container known as a smart contract. And this smart contract can then move across different chains and therefore move from one purchaser to the other, with each of them knowing everything that the most sophisticated even creator of the asset would know. And so the amount of information allows everyone to manage risk much better.
Right. So 21 Shares made an announcement yesterday about integrating Chainlink's proof of reserves for the ARC 21 Shares Bitcoin ETF. Why is this significant, and what do you think, how will that allow broader adoption of these types of assets?
Sure, so ARC and Cathie Wood and 21 Shares are very technically kind of forward-looking, and they make a lot of technical decisions, I think, that are foreseeing how things will evolve. So when they made their ETF, their Bitcoin ETF, they decided to use the power of blockchain technology to prove things about the financial product which they created. What Chainlink Proof of Reserve does is it proves that the ETF does actually have the necessary amount of Bitcoin in relation to what it says it has. And so this cryptographic proof happens on a second-by-second basis, proving that the assets are actually there. And this gives assurance to purchasers of the ETF that it is actually backed by Bitcoin that exists and is in the ETF's control, which is a large improvement from how ETFs prove their custody of things today.
Right. So, and of course, institutions, the biggest thing for them is transparency, which is exactly what they're looking for.
Right, transparency, but transparency for me is a dimension of risk management. So if I know that the collateral is there, if I know that the asset is in a certain state, if I know that the carbon credit is still valid, if I know that the real estate holding has not been transferred to someone else, my risk is reduced in buying that asset. And my view is that blockchains and Oracle networks and Chainlink and proof of reserves and all of these things together will play a very big role in creating a new format for all value. And that format will convey critical information in real time to asset holders that allows them to make informed buying and selling decisions in ways that are today not possible. And any asset that doesn't convey that real-time information that allows the holders to manage their risk will be an inferior asset. It will be an asset that essentially has more risk and is therefore less attractive. And that's what 21 Shares and ARC are kind of leading the way on in proving the backing of their ETF with proof of reserves and Chainlink and cryptographic proof.
So how is Chainlink and CCIP working with institutions to navigate the fragmentation within the expanding multi-chain landscape?
So I think it's a pretty definite fact now that every bank, every asset manager is going to end up having their own chain sooner or later. And what that does is it fragments liquidity. It makes all the value and all the purchasing power and all the client purchasing power of that bank or that asset manager focused on living on one chain. And then that purchasing power and those assets being on that one chain means that a connectivity problem emerges where the assets on that chain then would need to move to another chain in order to do a transaction. So if I have a client base of, I don't know, 1 million clients and they have hundreds of billions of dollars in my system, and then I represent each client with a wallet on my chain, then those clients want to buy assets from other chains. So that's the essentially cross-chain connectivity problem. The cross-chain connectivity problem has the same security concerns as the connectivity problem, the Oracle problem that Chainlink has already solved in processing 9.7 trillion. So Chainlink is now applying that same security model of Oracle networks to connect all of the different bank chains into a single internet of contracts, while also connecting all the different public chains into a kind of public chain internet of contracts. And then we're also now working on getting transactions between private bank chains and public chains so that the private bank world of each bank having its own chain and the public chain world can kind of merge into one large internet of contracts, just like you have the internet in general.
Right.
And so that is very important, because if you make an asset and you're not connected to all of these places where people have purchasing power, you don't have access to that market. Mm-hmm. So even if you make a fantastic asset and you launch that asset on one chain, if people from other chains can't purchase that asset, then your market is quite small. So it's a fundamental feature, I think, of any successful real-world asset, digital asset, tokenized anything, that it's going to need to have access to all of these other chains in order for purchasers to buy it. And then the purchasers are going to want to have an asset that can be resold to all the other chains, because they want to have the option to resell it to as big a market as possible.
So what's your advice for institutions that are looking to start their digital asset journey?
The progression that I've seen is to start with custody, so that you can provide or get a custody partner, but basically provide some version of custodying existing cryptocurrencies that were made outside of the bank structure, outside of the bank ecosystem, and that's just because there's client demand. The second stage is what we see now with ETFs, where there are more and more advanced ways to package, once again, cryptocurrencies made outside of the banking system. So not tokens made by banks, but tokens made by people outside of banks, like Bitcoin or Ether or whatever other cryptocurrency. The next stage that we're moving into now is that banks are generating their own real-world assets. They're tokenizing carbon credits, they're tokenizing real estate, they're tokenizing private equity, they're tokenizing whatever else they can tokenize. It's kind of another wave of securitization, but it's just called tokenization. And Chainlink plays a very big role in that by feeding in all the necessary data, providing the connectivity I mentioned. Basically, you're not able to do all of that bank tokenization without the data and connectivity that Chainlink provides. So we're very involved in working with multitudes of different banks and asset managers, really the biggest kind of institutional players in the world at this point. And they will launch some early versions of real-world assets, some simple versions, I think, of just tokenized carbon credits, tokenized real estate. And then after that, you'll get to another stage where the banks will get really creative, because banks and asset management firms, all these folks are very good at essentially packaging things into financial products that can, at large volumes, flow into the global financial system. The real-world asset trend that's starting basically this year in earnest with real production use cases is, I think, then going to really scale next year and the following year. And we're kind of creating the infrastructure and providing the infrastructure that facilitates and enables all those assets to go on chain. And then all of those assets will actually also flow to public chains. So if real world assets tokenized on bank chains might begin in the bank chain world, they will also eventually flow into the public chain world. And then the public chain assets will eventually be something that the bank clients and asset management clients of the global financial system also want to access. So both of those forces will merge everything into this one internet of contracts powered by the data, connectivity, and off-chain computation that Chainlink provides.
Right, and of course, I mean, the key to this is interoperability. I mean, certainly that's one thing I've learned, since covering Chainlink for the past number of years. So when you think even further out than that, let's call it the next 5 years, how do you envision tokenization and interoperability? What will that look like?
I think you have a once in a few generation shift of how all value is represented. So there is the initial kind of evolution of paper-based representation and transaction of value where everything is on paper. And then you have things like the paper crisis in the 60s and the 70s and the appearance of internet and network computers. And so everything went from paper to digital, right? Everything made a transition, a once in a few generation transition from paper-based representation of value, representation of transactions, to digital, to internet-based representation of value and transactions. Now we are in a similar transition from digital to what I call reliable digital, blockchain-based value. Cryptocurrency-based value, Oracle network-powered value, smart contract secure transactions. That is a once in a few generation, once in a few lifetime transition of how all value will be represented, managed, and transacted. So in 5 years, I think we'll be very well down this path with a large portion of the global financial system, a large portion of the core things like money markets and treasuries, and new asset types at the edges like private equity, real estate, green bonds, green carbon credit things. And then after 5 years, I think it'll only accelerate. I think this is the year where we're going to hit a threshold that everyone will know that this is what they have to do. And then from there, it will accelerate, because now all of the banks and all of the asset management firms, for the first time that I've ever seen, have dedicated digital asset teams. And so these people have a mandate to basically make these real world asset products. So in the next 5 years, I think we'll see the migration of value into this tokenized smart contract-based form. And then 5 years beyond, we'll see a rapid progression of really all value to be put into this format. So that if you own something, if you transact in something, if you get yield on something, if you trade on something, that's all being done on a blockchain, using oracles, using smart contracts, using data from things like Chainlink, using connectivity from things like CCIP. That's really the world that we're going towards, and it's not the world of a few $1 trillion sized market. It's a multi-$100 trillion sized market when you look at the amount of value that is going to get repackaged. And what we're really working on is how does that value flow into this new format in a way that brings along all the data, allows all the connectivity and liquidity to flow across counterparties. How do all of these additional problems beyond just writing the token code work? Because those are necessary problems to solve if you're actually going to have things work.
All right, appreciate the insight as always, Sergey. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.